Welcome to the Radius Plus Home Hangout. A lot of people are going to be trickling in. My name is Jonathan Aiken, part of the Radius team. We are, let's see here. It's May 22nd, around noon Eastern time, the start of Memorial Day weekend. But I just wanted to welcome everybody in. We have a special home hangout today, as we're going to be inviting a couple speakers in, one being Joe Saffire and two being Terry Campbell. We're very excited for for the conversations we're about to have between both of them. I just wanted to remind everybody, as people start trickling in, this is just going to be a completely casual home hangout. There's a chat functionality within Zoom that we encourage people to utilize to pose questions. Also, definitely feel free to push them to one of the Radius team members themselves. And if we don't have the answer now, we can certainly track it down for you. Just to introduce our team, my name is Jonathan again. We also have James DeGorder, Corey Sylvester, James McLean, and Tao Zhao all on the line from the Radius team. So today we are going to be chatting about a number of things, but to kick things off, I know Corey and I think Joe are going to head us off with a couple conversations. I think they're going to be speaking directly about the Rent Now platform first, which the Radius team actually got a chance to go see firsthand about a year ago now, last summer. I think the product itself is not terribly old. Maybe a couple of years, 2 summers ago, it was sort of developed, but now that we see ourselves in this ongoing global pandemic, it seems more relevant than ever to have something with the capabilities of online contactless renting and reservations, which is pretty exciting. So very topical conversation indeed, but I guess we'll just go ahead and kick things off with them right now. So Joe and Corey can go ahead and take it away.
Awesome. Well, Joe, thanks for coming on this little home hangout here. We love having you guys on. As Jonathan said, we were able to see the Rent Now platform up in person last fall. And if you saw a pandemic coming, you should have told us then, because you had great timing to get that product going. But from soup to nuts, it's the most cohesive thing that I've seen out in the market. And I did some shadow shopping today at the other REITs just to see what the experience was like. And it's pretty markedly different in terms of how you're able to actually rent and transact online, sign your lease. But what have you guys been seeing for those that aren't familiar with Rent Now? I don't know if you want to give a quick background to it and any sort of description about what uptick you've seen in terms of customer utilization. But I thought we could start the conversation there with contactless Rent Now discussion.
Yeah, thanks Corey, and thanks guys for having us. You're right. We've had it now for, we started piloting it about 2 years ago in Buffalo, and then we slowly rolled it out, fully rolled out, been a year now since we fully rolled it out to all our stores. And, we didn't know what to expect. Obviously this is a different customer experience storage compared to other self-serve industries like the airlines. But we were pleasantly surprised with the quick take-up rate at that time. It started out about 7-8% of our move-ins. And then it kept growing gradually. And then by the end of the fourth quarter, so this past December, it was getting close to 12% of our customers were using the Rent Now platform. And then we decided, I get questions, from analysts and investors, well, where do you see it going? Because we were able to save some payroll dollars. If you have a certain number of customers self-serving, they don't need to spend 30, 40 minutes at the counter. You add all that up in terms of hours saved, you can really have some payroll savings. And we started to recognize that sooner than we thought. But the tough question was, well, where is this going to go? Is it airlines? Is it not? Is it going to plateau at 15%? And then COVID hit, right? And holy cow, it's like the 9/11 for airlines. It really forced customers to learn technology, to self-serve, and it's been a game changer for us. So we started to roll out the Rent Now 2.0, which we can talk about in a little bit, and we put out a press release. And at that time, the students started to become customers earlier than expected because of the universities closing down, and it jumped to about 25% of our move-ins. And then in recent, weeks, it's even touched, north of 50%. And now it's hovering a little bit around 40, 45% of our customers. And we're doing things to encourage, more utilization. So, now we have different capabilities we've been adding to the platform. So if someone calls the call center and doesn't do right now right away, they can finish the process. So it's hitting, it's getting some really terrific utilization. I don't know where it's going to play out. I don't think it's going to go back down to 12, 13%. And it would be amazing if it sticks around 30, 40% and then slowly continues to climb over time. I think it's a great tool for the industry, and for efficiencies and for the customer experience. So it's been a game changer, and we're happy that we're out there in the front leading with this technology, and it's proven to be really important. And you see the other REITs and the others trying to come up with something, which is great. I think it's good for the industry, and it'll continue to improve over time.
Yeah. So the 2.0, I'm not as familiar with. What are the changes that you made?
Sure.
To
So
that?
yeah. So one of the knocks that we would hear is that when we came out with Rent Now is that we couldn't upsell. A lot of customers will come into the store and you hold them by the hand. You say, hey, look at this unit. It's only 5 steps from the elevator. If you want that, it's 10% more. Well, this Rent Now 2.0 solves that problem. It embeds dynamic pricing into the experience, and it makes, Corey, your life harder because now we have many different prices for one unit.
Yeah.
So you're scraping, I'm not sure what you're going to be seeing, but typically if there are spaces available that you have a premium spot, let's just say there's a spot that's, 7 steps from the elevator, we will charge a premium price for that. And the customer will see a standard price, what we advertise, and then a premium price, and maybe a value price for a unit that might be in the back corner of the facility that we have a hard time renting. So that's part of that Rent Now 2.0. It's too early to kind of give you any indications, but we are seeing a number of customers upsell and a number of customers take advantage of value pricing. So again, it provides more options for our customer, self-control over what they want to choose. And again, it's just a demonstration of our innovation in Rent Now. And again, it's going to continue to improve over time. But this is something really exciting for us. And I can't wait to see kind of the trends on Rent Now 2.0 and it is almost rolled out. I think close to 700 of our stores now have it. We kind of moved that up quickly. It was going to happen over the summer, but we were able to get this going, given COVID, a little bit earlier than expected.
Right. So it's, from what you just said, it sounds like the data is still incoming, but the upsell ability from online versus having a person there, do you have any sort of sense of whether you're able to convert a similar percentage of those people to premium versus value or standard, or is it just
I don't have a comparison, but I honestly feel that we'll probably be able to convert more customers than we traditionally have in the past.
Really?
You really depend on a manager to upsell, and and every manager is different. Some are good at it. Some might be too busy. So and that's something relatively, I wouldn't say new, but it's something that we all have been trying to implement at the store level in person. And there wasn't a ton of statistics around that success rate anyways, but clearly this is going to, be much better. I think we'll have many more customers choosing a premium spot than we had in the past.
Right.
But again, too early to say.
Right. Yeah. I mean, it's an interesting platform because there's one REIT that you go online and you're unable to do the full rent process and signing the lease online, which I thought was interesting, which just shows that there's, even with moving quickly, guys have not been able to implement it because it's pretty complicated, I guess.
Yeah, it is. And for us, one of the things, I think everybody's trying to obviously provide some sort of contactless process for customers, and some were already working on it. Maybe they had to bring it forward a little bit earlier than expected. But the one thing that we have done, which I haven't seen it yet, is we have a digital mapping of all of our properties, and that took some time. Yeah. What that allows us to do is, provide digital wayfinding directions to a customer. So they don't need to say, hey, how do I get to my unit? You know, stop into the office. They can literally, we're going to give them step-by-step instructions, or they get this now through their phone where their unit is. And I think that's a really important part of the experience. And, you know, that does take some time. So, you know, I think some other storage operators, you know, over time may be able to do that, but that's not something you can do too quickly, especially if you're not able to get too many people onto a premise. So, but that is something that is unique to us. And again, it's about providing that experience to the customer and making it as easy as possible for them. And we've been doing it now for almost 2 years. So got a lot of experience behind us.
Yeah, and the benefit to you guys by doing that is you start charging the customer. You can start charging the customer basically right away versus typically when you reserve online, it was you know a nice to have, but you really did. There was no transaction occurring, and you had to wait until they came into the store to actually begin with that revenue.
Premium for convenience too.
Yep. No, that's right. We get their credit card, they buy insurance, they get a lock, they buy a lock, and they typically are paying 4 days in advance of moving in on average. So that's 4 days of extra rent we're collecting for every move-in. So that's been something that's held up pretty well, even with the utilization climbing to 40-50%. We're still getting that 4 days extra rent.
Joe, you mentioned that you've rolled this out to all your stores at this point, so you don't have an opportunity to really do any A/B testing. But do you have a sense for what incremental traffic you're getting because of having this platform during COVID? Perhaps maybe market share that you're gaining, or you know, because you have a contactless thing, you know, in another world you wouldn't have had it. Any sense for?
Yeah, that is hard to say. I mean, April was a tough month for everybody. May's looking a little bit better. For sure, we advertised, you know, the contactless free, contactless opportunity, and I'm sure we gained some market share that way, but probably not too significant. I think, you know, again, if customers are shopping for storage, it's going to be, you know, the type of facility they need, the location, price. And now obviously, you know, this is something that adds into the equation of importance. So I don't really have any information on that, unfortunately.
Okay.
The one other comment that you made during the earnings call I'm interested in understanding a little bit more was you're seeing a lot of activity with Warehouse Anywhere, which, you know, again, people may not know much about that platform and how it interacts with your facilities, but I thought this would be a good opportunity just to explain a little bit about that. And I'm interested just to know how this pandemic may have shaped that business in terms of, you know, attracting customers or what's exactly going on there in terms of having that logistics angle through self-storage.
Yeah, no, thanks, Corey. I did mention it on the call. Someone asked a question, and, you know, for those who don't know, it's a B2B solution. You know, our Warehouse Anywhere includes a network of about 11,000 stores. So we have about 850 stores of our own, including third-party managed stores. But our network is 11,000 stores. So we have agreements with, you know, almost 10,000 other stores, so that if we have a customer, like a pharmaceutical customer who needs spots all over the country, we can service them with a portal and give them one invoice, and we will secure a space for them, and we will pay them, and then we get the payment from, and then we pay the other store that's a partner. And that's really part of how it started. And then we added some technology to provide inventory control for a number of reasons. We noticed a lot of problems with our customers having lost inventory and so forth. So that's something that's relatively new, maybe 18 months, 2 years now, where we will literally put in a unit, a technology that we own. It's like a chandelier that we put inside the unit, and it has RFID capabilities, and we'll manage their inventory, and it links right up to their ERP system. So it's pretty cool. It's proven to be a little bit of a longer sales cycle than just renting the space. And we've got some big names who use it, you know, like NCR, Allergan uses a lot for medical supplies and medical devices. And actually, you know, COVID hasn't created a huge demand for it, but we actually just, the business itself has been gaining steam as more and more people learn about it. And we just have a number of new customers we're piloting at this stage. And I think that's what I was referencing on the call, that June should be a pretty good month in terms of new customers who use it. But that said, I think if you take a step back at the storage industry and look at what may change post-COVID, I think more businesses, right? We've always felt, that businesses, we all know that businesses use storage. On average, 17, 18% of storage customers are business. We've had a pretty specific strategy around businesses. So ours is more like 25% of our customers, not all using Warehouse Anywhere, of course. But I really think, post-COVID, there's going to be more demand for storage for customers, businesses to have excess inventory nearby. And that plays right into the hands of Warehouse Anywhere. So again, we're going to be selling it to customers. We think it could be multinationals like Allergan, or it could be small businesses who just want to have some local technology in their storage unit. So we're doing both things. So we're excited about it. It's still, this is not something that's going to, quadruple in 6 months, but it's something that's differentiates us, shows that we have some innovation. And clearly everyone who's on this call realizes that storage is an essential business. And part of that is because of the importance of our supply chain for local businesses. And that's why we were able to stay open. We have a lot stored in our units for many, many types of companies. And we're excited that we have a product that, we think is going to help us going forward.
Yeah.
Joe, you mentioned you're excited about post-COVID businesses starting to rent more, have more of a need for it. What are your thoughts on the rest of the customer base? How do you think they come back? Clearly, as we go from not open to open, there's going to be, an increase. But where does that settle out? How quickly does it come back? Do you have any thoughts on that?
Yeah, I mean, when we're really in the heat of this in March, late March and early April, I talked to a few other operators, like Charles is on the call, and we would chit chat. And Pat Riley has been a great source. We're good friends and we talk. And all of us agree that, felt that coming out of COVID, there was going to be some pent up demand. People are sheltered in place for many reasons, obviously. And once we get out of this, we would see, obviously move out activity might pick up because it's been pretty low compared to last year, which is a good thing. But on the move-in side, we would see some pent up demand. And as we see some of these states open up, we are seeing some pent up demand in places like Texas and Florida, California, which is great. I don't know how long it'll last. The students have already moved in, so it's not necessarily students. But with storage, we get customers for many different reasons, and this one could be some restaurant owners who are deciding to close business and storing their equipment and furniture, or it could be businesses that are thriving and they need more storage. And it just could be personal residents. I think now you're seeing I think the report on mortgages was quite encouraging for the start of May. I think it's only down 1.5% from last year. Compared to April, it was down 35%. And as you know, the home buying is a real big reason why we have this seasonal peak for our industry in the spring. So, having home buying activity pick up will be a great win. And I'm still very bullish. I still feel that the second half of the year will be good. Let's hope there's no setback with COVID and a second wave, and more economies that stay open, and the industry should be okay.
Yeah, I'm thinking about, I'll be using storage probably for the first time in my life, as I'm probably going to move to the burbs here. It's forced my hand. So
yeah, that's a good point. I think you're going to see a lot of that. I know a couple of personal, situations where people are rethinking, do they need to have that apartment in Manhattan? Maybe it's a second apartment because they go there quite a bit and they got to get out of there and they got to store their goods. Or, you can work remotely now. You don't have to be in Silicon Valley. You can move to Wisconsin and sit on a lake. So yeah, I think that's a big one. And I think, I think storage will benefit from that.
I want to encourage anyone on the call, if they have questions for Joe. I've got one more here, but if you've got questions, please feel free to jump in. I guess my last one here would be sort of on the rates. We've seen, in analyzing the data, we've seen the web rates be more competitive than the walk-in rate, probably because there's not much demand out there. You're competing on the internet is very aggressive, but if someone does walk in this environment, you're sort of taking what you used to take. Is that strategy that you're adopting in the market and seeing, or?
Yeah, I mean, your street rates that you see on the web typically are what we typically receive. I mean, the walk-in rate is 10% or less, and it's obviously probably less now. But street rates have been down, and April, I think they were down 20%. And they've stayed down in May. I think that'll pick up as demand starts to pick up. Typically the peak season, you'll see, as the phones are ringing more, the prices will go up. But there are some other factors, such as state of emergencies, and each state and even certain cities have restrictions on raising prices during emergencies, and that includes raising street rates. So we first and foremost have to follow the laws of the land, and there are typically no exceptions. So we got to watch that carefully. But I think rates will rise as things start opening up across the country, which is a good thing.
Is the walk-in rate, though, you mentioned, doesn't get much activity there? I mean, people, even if they are walking in, they're sort of transacting at the
yeah, I mean, typically they walk in, you want to upsell, like we talked about earlier, the premium price. But most customers are pretty savvy now. They've done some research. They've seen a web rate. If they go in and get a walk-in rate, they'll mention the web rate anyway. Yeah. So it's very rare to find somebody who walks in and just takes it to walk-in rate today. It's it's a great one if you can get it, but it's not typically something we bank on.
It probably helps for setting expectations and negotiation. They feel like they've gotten a discount, so you just sort of throw it out there almost. Not really well,
if they don't mention it, we don't offer it. So.
Yeah.
But the taking web rates at face value, I'm starting to appreciate a little bit more from what I'm hearing from what happens 6 to 9 months after typically those tenants are in, is that the rental increases on the back end can change according to what the web rates are doing 6 months prior. So if you're more aggressive right now, and this is more of a question about how the REITs are handling this, it seems that if they're cutting rates as they have been over the last couple of months, that perhaps that's coupled with a more aggressive rate increase strategy 3, 6, 9 months later, whatever your interval is that kind of how to think about it? Because ultimately it on face value, like investors and everybody else and owners just see it as something where the market is just imploding.
Yeah, I mean, there are some who focus on occupancies is the most important thing. And, we try not to play that game. If you bring in someone at half a street rate, it takes a lot of in-place rate increases to get them back where it should be. And that could take years. And your typical customer leaves in 6 months. So, we're not, we don't necessarily believe in that strategy of having the lowest rate. There are other factors as to why customers choose you. One of the things that we have is that we have a 50% off special for 3 months. So in that case, the customer is well aware that they come in, they get a half price, but in the 4th month, it's going to go up, it's going to double. That's no surprise. That's a special that we do. But if you just bring in someone at half off with no special, I don't think anybody can get away with, we're going to increase them in 3 months and 6 months and 9 months. I mean, that just won't happen. And typically you might get one before 12 months, but then typically after that, it's once a year. So it takes quite a number of years to get someone up, if you brought them in at half of what you should have. So, but some just want to be fully occupied, and it's a tough one because we could if we all follow that, the rates would just keep going down and down and down. There has to be some discipline, and you see that every now. You know better than all of us. You scrape the web and you see what's going on, and I think eventually, I think right now we need to see demand increase, and I think it is increasing. So hopefully that will push street rates up.
That's good. We have a question from George Bell. He's talking about the REITs have been shying away from C of O deals, and he's asking, what is Life Storage's strategy for acquisition and growth?
Yeah, you know, we used to do a number of CO deals when they would lease up in 2 years. We haven't really played in the CO market. You know, our strategy last year, we had an asset recycling program where we sold off some of our more mature stores that were older, and we really couldn't do anything more with them, and they couldn't really drive NOI growth. So we took some of those and we sold those and used the proceeds, and we bought some lease up stores, but they were typically 50 to 60% leased up already, which we kind of like. We know where the rates were heading, and we're okay to dabble in that market. We do a few CO deals with some JV partners to grow. You know, the problem with CO deals, it's quite dilutive for REITs, right? We're publicly traded, and you know, if you buy, you know, something, you know, at a 1 cap or a 0 cap, it's pretty dilutive for us. And having a little bit of uncertainty of when this thing will lease up makes it hard for us to underwrite. So we haven't played in the CO market for a while. I don't believe our REIT peers have either. Some of them develop, and you know, I think Public develops their own. But you know, we have JV partners for that, to play in that game. But our strategy for growth is primarily, obviously, we'd like to buy into the REIT, more stabilized if possible. And then our third-party platform has been growing. I think we're one of the fastest growing at the moment. We're close to 300 stores that we manage, where we collect a fee, either JV or just third-party managed. And a lot of that has to do with a lot of the things that we've been doing with technology and Rent Now. So we're doing very well growing our piece of that business. And we're getting some spillover from some of the larger guys who've been doing it for longer, which is great. But, you know, we like to grow through a number of ways: acquisitions, third-party platforms, JVs. And then we also do about 50 to 60 million in expansions of our own properties. You know, that's quite good use of our capital as well.
Thanks for the question, George. I want to bring Terry into the fold as well, from Live Oak Bank, and transition a little bit into the discussion around what's going on with the lending environment. Terry, you there?
I am here.
So we, full disclosure, I talked with Terry yesterday just about, you know, catching up on what's been going on, and it does sound like you know, the lending environment is coming back. But Terry, maybe if you could kind of update us on what is happening from your perspective, what you see banks doing, what you guys are doing, and you know, that'd be great.
Sure. And Corey, as you and I have discussed, our life has been consumed the last couple of months with doing the PPP program, and it's we're kind of transitioning out of that a little bit now. So that's mostly behind us, and we are starting to open up to doing more lending. And again, mostly what we do, obviously, is SBA loans. You know, being the largest SBA loan lender in the country, most of what we're doing is SBA loans, and now we're kind of focused at the moment on doing SBA loans for projects that can be fully funded and dispersed before September 27th. And the reason for that is some of you may know or may have heard the SBA, as part of the CARES Act, they are being required to provide 6 months of P&I payments to borrowers who get a loan and fully fund that loan before September 27th. And so really, you know, the only ones that can do that are acquisitions. And so we've been focusing a lot of our time on that the last couple of weeks, and we still continue to do that just to help folks to be able to take advantage of an opportunity that's kind of a once in a lifetime opportunity. We've never seen anything like this, and hopefully there's not a reason to see anything like this again in the future. But right now, while the opportunity's there and the funds are available, we're trying to help folks to be able to take advantage of that are looking to do an acquisition or maybe even a refi. And we're focusing most of that around the 7A program. So in order to, because it's got to be closed and fully funded, it'll be tougher to do, real tough to do with a 504. So we're focusing on 7A. And as a bank, we've started looking at turnaround deals. I like to call them value add more than turnaround deals. Existing facilities. We are doing some new construction that we're going to start looking at now. Development deals for strong deals with strong feasibility studies and good borrowers with some strong liquidity and good credit right now. And obviously, as things get better and we see things starting to open up more and there's more confidence out there, we'll most likely continue to open that credit box up a little more. But I'll tell you, there is still a huge, strong demand that we're seeing out there. Folks still want to buy facilities. A lot of folks want to develop facilities. I keep in touch with a lot of the folks in the industry to see what's going on from different perspectives, and talking with some of the feasibility experts this past week, they are telling me they're extremely busy. They've got lots of folks that are wanting to build new self-storage projects. So they're very, very busy. So that's a good sign that there's confidence out there and that everybody is feeling better about things as things open up. They're feeling better about the future. That's, from our perspective, that's kind of where we are and what we're doing. There's also, there's some potential changes coming, positive changes that would be temporary in the SBA. I can't speak to them really because the bill they haven't been passed and made into law yet, but they're visible out there for people to find online. But there's some potential good, really good benefits that could be coming down the line this summer for the SBA program. As far as other banks, we've been getting a lot of higher credit quality coming to us because they haven't been able to get loans. And the ones we're talking to are just saying, a lot of them are getting left at the altar because the banks were just afraid to move forward. Maybe they were actually about to close and they pulled out on them. But we are hearing some banking is opening back up. Some banks are getting a little more confidence, but it's not wide open by any means, but we're seeing cracks and it, starting to open back up.
Right. So what is the criteria for 7A? Because that's obviously pretty interesting to have the government pay your mortgage principal and interest for 6 months. What are the criteria, generally speaking, in order to do a 7A loan?
The main criteria with the SBA that they put out is they say it's got to be a good credit score. So you got to have good credit. So it depends on who you ask to what good credit is. For us, we've maintained 650 or better. Each bank's perception of that's different. Some maybe want 7, some maybe a little less than 650. Some may be willing to accept a few delinquencies. Some aren't. You've got to be a U.S. citizen. You can't have defaulted on any other government loans like student loans or FHA or anything like that where the government has lost any money on you. And you can't be on probation or parole. And one of the things that we add, that's the 7A, but since we're talking, we add bankruptcies to that list. We usually shy away from bankruptcy.
Got it. Is there a loan amount limitation?
Yeah,
or loan to value. Actually, Bell just asked, what's the process timing for SBA construction loan in typical terms?
Well, it depends on your lender as far as the time. The more that the lender does, the better it's going to be and the faster it's going to be. We've always said, we can do the deal in 60 days if the third parties and such as appraisals and environmentals and so forth can act in a timely manner. And also if the borrower is a big part of it. How fast will they get their documents back? I always like to tell our borrowers that, hey, you are part of our loan team now. In order for us to get this done in a timely manner, we need your participation. You got to get us stuff as we ask for it. So, 60 to 90 days is usually, for pretty straightforward deals. We've done most of our loans in that time frame. And what was the other part of that question?
Just typical terms in terms of LTV, rate, etc.
For the SBA loan, they want to have 85% for collateral purposes. Is the LTV?
Mm-hmm.
And you can use third-party management for these, or no? That's still
Well, the answer is kind of tricky. The SBA changed their rules in the beginning of 2018, and we used to be able to accept third-party management from the REITs, and we have relationships with all the REITs. But when they changed their rules, the REITs weren't available anymore as an option, because the SBA looks at it as there is an affiliation issue, because typically the third-party management company is operating, especially the REITs, under their flag, and they're the ones managing it, so they consider that an affiliation issue. Now, there are some, smaller management companies, independent management companies, that were able to meet some of the qualifications to be compliant, but it mostly revolved around the employees. The employees had to belong to the borrower, and it messes up the business model of the REITs when you're trying to operate under a couple of different management scenarios with personnel.
And that's still the case with this.
Yes. Yeah. As of right now, that's still the case. I mean, you would think that in a way they would prefer to have the professional REITs because there's less risk of them having to pay out on a default when you got somebody with the knowledge that these guys like Life Storage has.
Right. Kristen asked, can a 7A be applied to larger capital improvement projects that we may have been holding off on?
Yes, you can do renovations and capital expansions with 7A.
And can 7A be a development loan as well?
Yes, a lot of since we started lending in early 15, I'd say it's still an average of over 80% of our portfolio was probably somewhere around there was new construction and development. And one of the reasons that we would usually suggest the 7A, because with the 7A we can include your working capital and your lease up payments, while you're in lease up, so you don't have to feed it out of your pocket.
Right. So if you can close, so it looks like we got 128 days before that deadline. So technically you could get a development loan and get this first 6 months paid of interest and principal.
Well, the development deal is not going to be able to take advantage of this, because it has to be fully funded. And for it to be fully funded, it's got to go through construction, lease up, capital, everything. That's why we're focusing on acquisitions, because those, with a 7A, we can, churn and burn through those and help folks take advantage of that.
Right. Generally speaking, how does the interest rate work in terms of how it's set with 7A loans?
7A interest rates are typically based on prime as the index. Each bank prices it the same. You can get floating rates that will adjust quarterly. You can get fixed rates. It depends on the bank you're working at. Some banks aren't going to do a fixed rate, but we've done fixed and floating, and it's usually always based on prime.
And to confirm, SBA loan may only be used if self-managed. That was what George Bell was asking.
No, not just self-managed. Self-managed obviously does work, but like I said, there are a few of the third-party independents that we've been able to work with to get an agreement compliant so that they meet the requirements of the SBA. And again, mostly that revolves around personnel, and the personnel have to belong to the borrower.
Right. And what about another question is, can the SBA loan may only if a project's in lease up? So can you buy a non-stabilized facility with a 7A loan and get the same benefit?
You can, but right now, if it's in lease up and not stabilized, it's going to be tough to get one approved right now until things get a little better. But it's not impossible. So there's nothing in the SBA that prevents that.
Right. And another question on, was there a maximum loan size as it relates to this?
With the 7A program, it's $5 million is the maximum amount.
loan.
I mean, we can do more than that with a 504. I mean, if your objective wasn't to try to take advantage of this 6 months, we can do larger loans with a 504. We can even do larger loans, or in the past we've done larger loans with the 7A. We would do, the 5 million that the SBA will cover, and then we'll do a pari passu conventional loan to go with it to help get you over the finish line. We've done plenty that were 7 or 8 million where we brought in 2 or 3 million as a conventional companion to go along with it.
Right. So the 80, you said 80% loan to value was the
85.
85. Okay. James, you had a question?
Yeah, just switching gears a little bit here, but it sounds like, Terry, it sounds like you're primarily focused on these 7 days for the foreseeable future, more on the acquisition side. As you look out 3 to 6 months, as you mentioned some development activity, is you're seeing some signs of it. Where do you think your volume sort of settles 3 to 6 months out from now versus pre-COVID?
That's a good question. That is yet to be seen. I wish I could answer that. I'd love to be able to answer that right now, but I don't know. But we are, like I said, the main reason we're focusing on 7A acquisitions is just to help folks take advantage of the 6 months. But we're still looking at right now, we can still look at and process the construction and development loans as well.
What if we take that in then short run, what is volume like or activity like for construction loans versus 3 months ago?
Oh, I would say today for the next several weeks, probably 50% of what it was.
Right.
And obviously that will, as things continue to open up, that'll go back up.
Right. Interesting.
Another question, is there a priority to process certified minority or women-owned owners first?
No, there's not.
Okay. And so with the construction loan, you said that you're doing 50% of the volume that you probably were doing 3 months ago. Is that trajectory rising?
Well, that guess is we've literally just this week started reviewing new development loans again. We've just started that, and we've got a lot of folks that are calling us. And the 50% that I'm talking about is what I'm expecting us to be able to accept and process and get credit approval on today. Just because we're just getting back into it, and we're requiring a little more horsepower, a little more strength than we would have in the past.
So that's pretty good. I mean, Corey, we were discussing this 6 weeks ago, and you were saying one of the big differences between this downturn and the 2008 was, the banks, are well capitalized and can rebound much faster. It certainly seems to support that.
And we didn't have the SBA back then either. The
Right.
SBA self-storage only became available to self-storage in October of 2010. And that was like the bottom of the trough as far as new development.
What are you seeing in terms of people that you were sort of like down the process and they're just giving up now or canceling projects sort of later in the cycle than they typically would, or are deals dropping out? We spoke to a couple of clients that sort of gave up on a number of projects that were fairly well down the process. Right.
Well, I know some of them are definitely doing that. Just say, hold on, don't throw in the towel for good. Just stand on the sidelines for a little bit and see what happens. And like I said, we're looking at ones that are strong deals with strong feasibility studies and strong borrowers right now. Even with the guarantee that we have that helps us to do that. And again, if some of these changes that I was mentioning that they're batting around at the SBA do happen, they may be able to get back into the game faster.
Yeah, that's it's one of the questions I have is I've talked to some people that think that this is the end of the development cycle, but interest rates are going to be zero for a long time. Construction costs are going to be coming down, and if you can still find a pocket, people are going to be going after it. So it sounds like activity on your end is rebounding, which is more conducive with some sort of continuation of the development cycle in some form. I'm not sure exactly what that looks like, but
it would be great if development continued, but just at a significant, at a lower
lower trajectory. Yeah,
Lower
it was.
trajectory, yeah.
It's been almost, straight through the ceiling for 4 or 5 years,
Yeah.
and a lot of that was caused by the pent up demand of nothing being built there for a few years during the Great Recession. And I think, all that was one reason. The hype of everybody finding out about how great self-storage is no big secret anymore. It wasn't under the radar. Everybody's seeing how great of a business it is. And a lot of people just were doing a lot of stupid things. So, there were things that, shouldn't have been built. There were things that we wouldn't finance because they shouldn't be built, but they found ways to do it. They found money to do it. So it's a great business, but hey, it's only a great business if you do it at the right place.
Yeah, if things settled in at 400 or 500 projects a year instead of 1,000 plus, then
Yeah.
much healthier and better for everyone in the industry.
Yeah. Joe, the life is kind of halted its capital projects. What are the factors that you guys are kind of considering as it relates to restarting, all the activity that you guys had been underway with, whether it be redevelopment or otherwise, in terms of putting your capital to work?
Yeah, obviously when COVID hit, we wanted to take a step back on some of the external growth levers. Acquisitions we paused, not just because, we want to preserve liquidity, things like that, but it's just unclear as to how do you underwrite during these times, right? Where are rates going to settle? What's going to go on with collections? Too many unknowns. And then in terms of preserving liquidity, we slowed down some of our expansions, enhancements, but not a ton. I think we had 60 to 70 million planned. We'll probably scaled it back to about 40 to 50 million. But, as we get on through this, we're obviously feeling more comfortable. As the debt markets reopen, that was another consideration in terms of acquisitions. The debt markets kind of dried up. We'll be a little bit more willing to put those back into play. I think, we like what we're seeing, with what's going on in the economy, moving out of the shelters in place and reopening. And, I think we're getting a little bit more visibility, but it's still, it's going in the right direction, Corey, but, we're not yet ready to jump right back in.
Yeah, that makes sense. I'm still kind of waiting for some sort of shoe to drop with all this loss of unemployment. I would have expected more of a dramatic impact to the fundamentals, and I guess we haven't been open that long to see it actually hit, if it is going to hit. So, that's kind of the question I have.
There's been a lot of stimulus, right? I think if you have a $100 storage unit, I think you could probably come up with $100 if you're getting a stimulus check and you're getting enhanced unemployment, and you can delay your mortgage payment. So I think in the short term we're okay, but if this is prolonged, that's the question mark. Will it be prolonged? Will people be able to go back to work? And you're starting to see restaurants reopen slowly. So, and people are starting to fly a little bit more. So if we keep it that trend and there's no setback, I think we should be okay. But in the short term, I think, government's done a great job of providing stimulus, and people have money in their pockets. They're not driving around. They're not spending on gas, not going out. And they're getting some extra cash in the bank from the government. So I think that allows people to make their storage payment for a few months.
Yeah, that's true. Are there any other questions, anybody else? Because I'm all out.
I'll tell you, it's exciting to seeing things open back up. And for me, I'm extremely excited because our barbershops open up at 5 o'clock here today.
I need to come see you then. No barbershops open here.
George, I'll how do we discuss a JV with Life Storage? Well, George, I can connect you with the Life Storage guys via email. Happy to do so. I've got your email.
That'd be great. Thank you, George.
Yeah. Then Linda just has one question here on a personal guarantee for loans as well.
So I guess Linda's asking, is there a personal guarantee required for SBA loans?
Is there a personal guarantee? Yes, there is.
Yeah.
Yes, it is a recourse loan for the life of the loan.
And then Henry saying, can you syndicate using 507A? I have no idea what that means, but Terry, you probably do.
You can, syndicate using either a 504 or a 7A, but somebody is going to have to sign the note. So at least anyone who's 20% or more owner in an SBA loan is going to have to sign the guarantee. And if nobody is 20%, at least one person has to. So usually if one person has to, they're typically not going to be too happy about everybody else not being on the hook too.
Right. Well, thank you for all the participation on the line. I think an hour of discussion about self-storage is about all anybody can take. But Joe, you know, you're great to be on here. Thank you so much for coming and spending the time with us, and Terry as well. You gentlemen are great. Thank you so much.
Thank you, Corey. Love what you're doing, Corey, on LinkedIn and your videos. It's great stuff. So keep it up. And yeah, everyone have a great Memorial Day weekend. And this is the Super Bowl for storage. Let's hope it's a good one.
That's right. That's right.
All right.
All right, guys. We'll see you soon.
Take care, everybody.
Take care.
Thank you, everybody.
Bye-bye.
Bye.